This is Chapter 11, Video 4. Let's launch. Okay, so for the learning objectives for this video, we're going to have explain common deferral exceptions to the general rule that gains and losses are recognized currently. All right, so the first one is going to be 1031 exchanges, they're like-kind exchanges, but they're referred to by the code section 1031. You'll hear about these a lot, and when you guys do your CPA exam, you'll see this question probably pop up in the CPA exam. You'll have to do something related to this. Obviously, I can't tell you what was on my CPA exam because I did sign the document that said I wouldn't talk about it. But I do know that this is a potentially covered subject. And so what happens is, the way I normally do this is, hold on one second. So I have in my hand right now a Coke. It's a Coke Zero, yeah, because I'm a little on the heavy side, and so I tend to drink Coke Zeros. And when I have my Coke Zero, normally when I'm in class, the way I do this is I bring in the Coke Zero. Usually it's either in a bottle or in a can, and I try to find a student who's having another drink. And I'm a little vindictive in sense. Sometimes I go to the quiet student and I go up to them and I ask them this because if I do that, they're like, "Oh my gosh, why is the professor talking to me?" And what I do is I bring the Coke Zero and I say, "Look, I have a Coke Zero. You have a drink." We'll say that person's either drinking coffee or we'll say it's another Coke. And I say, "I'm going to swap my Coke Zero for your Coke. Is that okay?" And usually the student that I choose is intimidated and says, "Yes, they're going to, yeah, I'll whatever." Okay. So we swap the drink. What economically has taken place? Economically speaking, nothing's happened. I had a Coke, you had a Coke, we swap, you now have a Coke, I have a Coke. Economically speaking, nothing's happened. And that's kind of how this happens with like-kind exchanges. If I swap one piece of property for another piece of property, basically what ends up happening is that, economically nothing's really taken place. And so when they came out with Code Section 31, they could do Code Section 1031 on pretty much anything. You could do it on, land for land, building for building, land and building for land, or whatever. And then you could also do it for personal property. So if I had, a machine that, produces, pins and needles, and I swap it for another machine that produces pins and needles, we could effectively do a 1031 exchange on those if we wanted to. Now, traditionally speaking, the time that you're going to want to do 1031s is going to be on property that has appreciated in value. And so most personal property does not appreciate in value because we know you're going to sell it and you're going to have a loss on it. You're probably not going to be worried about giving it to somebody else and trying to get, tax deferral treatment on it. What's going to happen is you're just going to say, "Okay, I'll sell this to you. I'll buy your machine." And then, we both recognize losses and we kind of move on. But that's not what happens oftentimes in real property. Now, in the old days when they used to do 1031s on it, usually you'd have on your tax guides. And like I said, I've got the tax guides right here. They would actually have a listing of all the property that you could do, in some examples, because in a lot of these quick finders, obviously they're not going to be all encompassing. So what would happen is they give you some common examples, and from that, you could kind of get the idea of what's going on. So for example, I know a very popular dog nowadays, toy dogs are actually Yorkies. Something that most people don't realize is that Yorkies used to have an actual purpose, and their job was to go find, rats and other vermin on farms. And so their job was to find that, kill it and then get rid of it so it wouldn't eat the crops and things of that nature. And so that's why farmers used to use Yorkies. So if you were a farmer, maybe you'd have, 20, 30 Yorkies that you'd be raising, you'd feed them, you'd take care of them, and then they go out into the fields and they would clean the fields for you. And then they come, and then you would have to deal with the vermin and all that sort of stuff. But say, for example, I have a Yorkie that's a little old. I don't want the Yorkie anymore because he's not able to do the job that I need him to do. So I might swap that Yorkie for a baby Yorkie so that I can get that. And then that way I wouldn't have to recognize any gains on that. So that's kind of how that would happen. A Yorkie for a Yorkie is not difficult to do, even though the Yorkie that I'm swapping out is old and then the new one is going to be a puppy that I've got to train. But the IRS was pretty generous on this when they came to like-kind exchanges. But, an example of a like-kind exchange that would be disallowed, if I swap a cow for a cow, I didn't have a problem. If I swap a bull for a bull, I didn't have a problem. But if I swap the cow for a bull, even though they're the same species, because the cow is usually used on a farm to produce milk and the bull is usually used to produce steaks, the IRS would actually deny like kind of treatment with that. So, 1031s used to be, in my personal opinion, they used to be a lot of fun. When you do it, because again, I told you, I'm not a numbers guy primarily. I'm actually more of a problem solver. And so when somebody would come to me and say, I've got this thing I want to get rid of, I want to buy a new machine in order to be able to replace it, can I do like kind of treatment on it? And in some cases we could do it, in some cases we couldn't. Now, in 2017, as a part of the Tax Cuts and Jobs Act, they got rid of a lot of things that qualified for like-kind treatment. So now it's only real property. So real property is the only thing that you can do on 1031s, which as a CPA, I mean, I didn't actually do any 1031s when I worked for other people, but I actually started doing them when I owned my own firm. This is when, I mean, but before this, I obviously help people with 1031s that are like, what I would do is I get into the VSCPA chat room, or I'd get into some of the other chat rooms and I would help people out with some of that. And that's actually how I learned, was by doing that. So it helped me, apply tax law and all that stuff. And it's actually something I recommend to you guys. If you're want to get into tax, you want to get smarter about it, you start learning how to do this research. It actually can lead to jobs. I actually had a person in the VSCPA, after I helped them in the chat rooms, they came back to me and said, hey, you seem like you're really smart about this stuff. You want to come work for me? The bad news was at that time I was still at KPMG, and I was like, yeah, I'm not going to do that. So I decided not to do it. But it is something that I found to be very useful for me to be able to go out to the community. First of all, give back to the community. So it's service before self. We do that. But also, it also got back to that excellence in all we do, because by helping somebody else, I got something as a result of it. And so I would actually help people out with that. Now, ever since I had my own firm, all the 1031s that I've ever done are on property. And again, where I've actually had to fill out the tax return, have to fill out the forms and make sure that we ended up doing this correctly. That actually was something that I now have a lot of experience doing. And so the 1031s that you do, so if you swap land for land, land for building, residential real estate for commercial real estate, they're generally going to allow you to do this, because when it comes to land transactions, the IRS has actually been very, very benevolent, shall we say, in allowing different types of 1031s that could take place. So what'll end up happening is, they say here it's solely for like-kind property. We'll define that later on. But the real property given up and the real property received must be held either in a trade or business or held for investment. Now, I have worked on cases before where somebody said, look, we're going to do a 1031. We're going to rent this house out. But the eventual goal is 10 years later, we're going to move into this house as a personal property, and then we're going to take over on it. But it's going to be a rental until that part. And then when we retire, we're going to take over the house. So you can do that. But the IRS is very cautious about this. If they think that the sole reason why you're doing it is because you're trying to get set up for that 10-year retirement, they're going to deny it. And now that's not why they did this solely. It was because the house that they were trying to sell skyrocketed in value, and it was worth a lot of money. And so what they said is they wanted to swap it out so that they could trade it for another piece of property that they thought was also going to generate money for them. Actually, they ended up paying more for the second property, so they put money into the 1031, which of course one of the benefits of that is that actually increases basis in this. But obviously you can't do it for that sole purpose. So then you have to meet certain time requirements that we'll go over later on. So definition of like-kind property. You have trade, used in a trade or business or held for investment. What does that mean? In other words, it has to be something that you do in your Schedule C, something in your partnership, something in your corporation, or it has to be something, for the investment that when, again, the book, the way they explain investment, that's you're talking your production of income activities, like under Code Section 212, where you got a rental property. I own a house. Like, for example, I actually have 2 houses down in Florida. We rent them out. If I decided that one of my houses is kind of a pain in the butt, we're going to go ahead and we're going to sell it and we're going to go buy another house. That is something that is entirely possible to go do. And then as a result of that, we could do a like-kind exchange for that. If I held it for business, and then if I do the if the property acquired is going to continue to be held in a trade or business, I can do a 1031 on it. Now, the other person who sells me the house, maybe they're not doing a 1031. They don't have to be that. They don't have to do that as part of this. The like-kind treatment actually gets received by the taxpayer, actually does it. And so that's an important consideration to say. Property that's ineligible for it, property that's held for sale, for example, inventory, accounts receivable. I don't know why you'd want to try to exchange accounts receivable. I mean, I'll swap my bills for years. I mean, that's kind of ridiculous. Inventory would probably be a more likely candidate for this. Maybe I have a whole bunch of stuff and I don't want to sell it anymore. And so instead of, but I have another product that I'd like to sell. So I go to the company and I say, hey, I'll give you this in exchange for this other kind of inventory. That's not allowed to be done under Code Section 1031 for like-kind treatment. Also, if the property is used outside of the United States. So, for example, if I want to buy a property, if I have a property that's located in Costa Rica and I want to do a 1031 on a property here in the United States, I can't do that because it comes from outside the United States to inside the United States. Not allowed. Also, domestic property in exchange for property used in a foreign country, the reverse is also true. So if I want to do a 1031 exchange where I'm going to be swapping property from from here in the United States for that property down in Costa Rica, I can't do that. And that's something that they will actually forbid you from doing. And I think a lot of that has to do with compliance. It's very difficult to do compliance for properties because here's the problem that they have. What if 10 years later you want to dispose of that property? And say, for example, it's in a country that the IRS doesn't have, maybe great relations with. Say, for example, I buy this property in Libya. If I was allowed to do this in foreign countries, IRS has no relations with anybody in Libya in order to be able to make sure that the 1031 is being maintained. And I think that's part of the reason why they did this is due to compliance problems that it would create. Property use, you have to use it for the business or you have to use it in investment. We've already talked about that. Timing requirements. These are the important gates. 45 days, you have to identify the property. Now, some people might say, well, if I identify the property, how are they going to know whether I've identified it or not? What's going to happen in a 1031, we'll go over this when we talk about the process with this, you're going to have to use what's called a QI, which is a qualified intermediary. A qualified intermediary is basically a title company that specializes in doing these types of things, and they meet certain qualifications that the IRS sets out. They're not going to bust their qualification to save you. They're going to make sure that they maintain the rules because that's what they set it up for. If you go to them on day 46 and say we've identified the properties, they're going to be like, "Sorry, Jack. Sorry, Jack. Chucky's back. You're out of luck." And as a result of which, you're going to have a busted 1031. So your clients, and here's the thing, normally I'll tell you what, when I've done 1031 compliance work on this, out of the 7 or 8 cases that I've done in the past, since owning my own firm, I've had once where they actually came to me ahead of time and said, what do I need to do in order for this to happen? Most of my clients who've done 1031s for real property, they've already done these in the past, so they kind of get the game, so they already know it. And then the one that actually didn't come to me that had never done one before, they hired a real estate agent that was like, oh yeah, we can help you with this. And they work with the title company and the QI to get all that stuff set up. So it actually ended up working out really well for them. In the grand scheme of things, I would say that, like I said, you got to hit that 45 days. Now, here's the thing. The IRS has come out with, I think it's revenue procedures they came out with that basically said, look, if you do a property identification, we will allow you to identify up to 3 properties. And I can't remember if it's a Rev Proc or a Rev Rule, but it was one of the two. And they said, we'll let you identify up to 3 properties. So if you identify 3 properties, you want to tell your clients to do this. And here's why. Say, for example, you go out there and they sell their house. They have 45 days to identify the property. They identify 1 property. As they identify the property, and then they go and they talk to the person and say, okay, we're going to schedule the termite visits and blah, 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 so on and so forth. Termite inspector comes back and says, this house is useless. There's too much infestation. It's going to have to be knocked down. So the house that you think that you're buying for $200,000 is actually worth whatever the land is at $35,000. That is a bad day because you will bust the 1031. You'll find another property, but maybe you don't find out about this till after the 45 days have expired, at which point you don't have a backup. So you want to tell your clients, if they do this, identify 3 properties with a QI that you'd be interested in purchasing, go through, do the process for 1, and then, hope to God that the other 2 don't get sold. And that's another thing that could happen. Your first one dies down because of termites. Your second one gets sold. Now you got a third one that you can at least do so you can keep the 1031 and do this. The whole transaction has to be done in 180 days. All of my clients I've talked to, this has never been too much of a problem, especially nowadays. Most of the time, title companies are on board with this, and especially if you got a QI that knows what they're doing, they know the gates they got to hit. And if they're the reason why you bust a 1031 rule, that's a bad day because then they have big liability as a result of it. Back in the day, actually, hold on a second. I'm going to bring this up, and now I'm going to talk about what I was about to say. So getting into that third-party intermediary, they say here third-party intermediary. We always call them QIs, qualified intermediaries. I've noticed in the past that, like with a lot of the QIs, in the 80s, they used to be really expensive to do, but you could do 1031s on anything. So if you bought a personal house and you wanted to sell it and buy another personal house, you could have done a 1031 on that back in the 80s. So, but if you wanted to do it, you go to a title company, a lot of the title companies say, well, we're all specialized and blah, 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 so on and so forth. As a result of which, we're going to jack up prices. They've actually gotten down on price a lot. I would say it probably would cost around $3,000 to $4,000 back in the 80s. I've seen them go as low as about $900. Where they say, look, we're a qualified intermediary. In addition to all the other title work that we have to do, we're going to charge you $900. And I've seen that happen a lot. I mean, free markets have really brought the prices down. And so that's actually really good. But this is basically how it is. And you'll notice they call it a Starker exchange. It's actually named after an individual who, and I don't remember the exact story on this. And I mean, if you want, I've got slides. I used to teach 1031s all the time about 4 or 5 years ago. I've actually got some stuff that could go into that, but sometimes you'll hear them called Starker exchanges. Sometimes you'll hear them called 1031 exchanges. You can also do what's called a reverse Starker, where you don't have to sell the property that you're going to do first. You could buy the other property first and then sell yours. There's still certain time gates that you have to reach. I'm not going to get into that. Again, a reverse Starker is kind of outside of the realm of this class. But it is something that could be an option for certain clients who are this is just a pain in the butt for them. They don't want to deal with it. The way that this is set up, it works out better to do a reverse Starker. They can do it. I will tell you though, reverse Starkers are much more expensive to do than regular ones because a lot of QIs won't even touch them. So the market hasn't really driven those prices down as much. Tax consequences. So what happens is, again, basis given is basis received. Remember, basis given is basis received. Basis given is basis received. Basis given is basis received. All right. So you're going to do basis given is basis received. So if I give basis, say I have a house that I bought for $200,000, it's worth $400,000. I'm going to go buy a house for $400,000. What's going to happen is, and say it's we'll say this is a vanilla 1031. You go buy the house for $400,000. You sell your house for $400,000. Use all the cash. Go buy that next property. There's no loans, nothing to worry about. And in exchange, you get that house. The basis that you gave to that house is going to be the basis in the new house. That's how this happens. Now, where this gets complicated is when you start doing things like boot. Say, for example, instead of buying a house that is, I sell my house for $400,000. I'm going to buy a house for $300,000. The basis transfers over, but $100,000 of that comes back to me because I bought a house that's $300,000 less. What will end up happening is you will end up having to recognize portion of that gain. Now, the reverse is also partially true. if I buy a house, say I sell my house for $400,000, I buy a house for $500,000, I end up putting an extra $100,000 into that house. That's going to increase the basis given, basis received plus that $100,000. And so that's how this is going to kind of work out and how that kind of flows and all that sort of stuff. So that's kind of how you deal with all of this. To be honest, most of the time I do this, the computer program calculates a lot of the stuff. I follow it and make sure that it makes sense. And sometimes I'll build Excel spreadsheets in order to do this. More time often than not, I won't. The computer program I've come to trust that actually knows what it's doing if I put the inputs in correctly. And so I kind of know what I'm doing with these. Now, if you've never done one of these before, you might want to build an Excel on your first one, just so that you can kind of get the math set so that you know what you're looking for when it comes to this. Now, there will be sometimes that you'll get something that kind of adds up. So you sell a house that's a rental and it's got 10 assets in there. Maybe some of those assets are sold at a loss because maybe they haven't had enough depreciation on them. That could actually complicate things with this. And sometimes having that Excel sheet gives you the essay to be able to go back. And when I say essay, I mean situational awareness, to kind of look at it and say, oh gosh, the tax program is telling me that my taxable gain on this is $100,000. My calculation on my Excel said 70,000. I'm going to try to figure out the reasons why. And sometimes that helps you build a better product. And so you want to make sure that you're doing that. Again, when boot's received, gain is recognized to the lesser of gain realized or boot received. And then point 3 is the adjusted basis of, this is basically the calculation that they use on this. I promise you add, subtract, divide, multiply, but I didn't promise you how many times you're going to have to add, subtract, divide, multiply in accounting. But again, add, subtract, divide, multiply is the way that we do things in accounting. You want to do calculus and all that other stuff, go to finance. They can do that. You can do the Black-Scholes thing so you can figure out what your options are worth. That to me is really hard math. Then they come at point 4, basis of boot is received at the fair market value of the boot. And then of course, adjusted basis of the boot received for point 2, adjusted basis of the boot received is fair market value of the boot. That is important. All right. You report these, the reporting of the like-kind exchanges. There's actually a form that you fill out. Like I said, most of the time the software will produce that for you. So you're not going to fill out directly, but it does get reported to the IRS. So they can maintain records on everything that they've got. Involuntary conversions. So if I have a house in Florida and a hurricane comes through and blows through, that's going to be considered an involuntary conversion. I can defer the gain off of that because the IRS looks at it and says, look, you didn't put the house on the market to sell. Mother Nature took care of that for you. So you destroy the house. What'll happen is you destroy the house, you get insurance proceeds, you rebuild the house. There's some calculations that you've got on that. There could be some deferred gain as a result of that you need to take into consideration. All right. Installment sales, quick and dirty on this. So say, for example, I have a piece of land and I'm going to sell it to a person for $1 million. They don't have $1 million, but they make money and they say, we'll pay you $100,000 a year for your land. The $1 million land that I bought, that I sold, I bought for $700,000. So if I had sold this land for cash, $1 million, I'd have gain of $300,000. $300,000 gain, sold it for $1 million, bought it originally for $700,000, gain is $300,000. Okay. But I don't recognize that gain immediately because I didn't get the cash yet. And I'm a cash basis taxpayer. So as I receive $100,000 a year, I have to recognize a portion of that cash as gain as I'm receiving that for the property. Okay. And the way we calculate that out is we take gross profit, which is the $300,000 I did divided by the contract price of $1 million. That gets you to 30%. And so as I get $100,000 each year, $30,000 will be recognized as gain on the sale of that land. Now, you've got some things that you can't do on the installment rules. For example, inventory, marketable securities, depreciation, recapture. So if you have some depreciation recapture, you'll recognize that in the year of disposition, whether you want to or not. And now the good news is that will also deduct from your gain That'll deduct from your gross profit. Whatever you recognize immediately has to be deducted from gross profit so that when you receive the cash over the years, you'll receive less gain on your tax returns that you have to pay taxes on. And the rules don't apply to losses. So if I bought the land for 1.5 million, I do an installment sale for $1 million and I do installment times, I take the loss immediately at the year of disposition. And then every time I receive cash going forward, nothing to report. It's actually a pretty good deal. Other than the fact you got a loss. that stinks. Gains ineligible for installment reporting. Gain recapture is going to be one of those. There's also going to be some non-recognition provisions for if you do it to a related party. So like if I sell my land to my brother, it's worth $1 million. I bought it for 1.5. I sell it at a loss. They're basically like, that's basically the same taxpayer. There's nothing there. So the rules, and actually, give me a second. I want to talk about related persons. You need to make sure you're looking at the right rules for what a related person is. Again, we're dealing with property transactions, so it's going to be 267 that's going to do this. There could be other related party transactions that you're going to do that have different definitions of that. For example, the foreign realm has certain people they call related parties that the corporate realm does not, and that 267 does not. So you need to make sure that you're following the related party rules within that specific one. And usually when you start doing these, they'll refer to them. So I believe it's an IRS regulation that actually refers to this. Go to 267 to determine who related parties are. And that's usually how it ends up being. So loss on sales to related persons are not deductible by the seller. Just like if you sold, like if I sold that, say my brother had $1 million, my brother doesn't have anything, but say he had $1 million and he wanted to give it to me for the value of my land of 1.5 million. I'm not going to be able to do this. They're basically going to say, you've just transferred it to him. He gets the loss when he sells it. If he sells it to a third party. So, it's going to be disallowed as of that. All right, so that's all I got to report for today's class. I want to say thank you very much for watching this video, and I look forward to seeing you at the next video.